Good day. The headlines this morning may sound alarming, but let's take a closer look. On Friday, Moody's Ratings officially downgraded the United States long-term credit rating from A to AA1. That's one notch lower, and it means the U.S. has now lost its top-tier credit rating from all three major credit agencies: Fitch, S&P, and now Moody's. Stock index futures tumbled Monday morning on the news. The Dow was down over 300 points in early trading, while the S&P 500 and NASDAQ 100 dropped more than 1%. Yields on the 10-year Treasury also spiked, reflecting higher perceived risk. But here's the twist. Smart money isn't exactly panicking. Moody's itself changed the U.S. credit outlook from negative to stable, meaning no further downgrades are expected in the near future. And experts like Ryan Dietrich of Carson Group were quick to point out that Moody's, like the others, is merely catching up. Dietrich reminded investors that Moody's still had Lehman Brothers rated A2 the very day it collapsed in 2008, so these downgrades tend to be reactive, not predictive. In his words, not a huge shock. Even Deutsche Bank analysts noted over the weekend that Moody's had flagged this potential downgrade all the way back in November 2023, and a move was widely expected within 12-18 months. So is it really a game changer? Not likely. Historically, when S&P downgraded U.S. debt in 2011, also amid debt ceiling tensions, markets briefly dipped but quickly recovered. In fact, the S&P 500 ended that year positive. Today's downgrade cites ballooning U.S. debt, now at $36 trillion, and forecasts that the debt-to-GDP ratio will rise to 130% by 2035 without spending reform. But again, none of this is new information to institutional investors. What makes this different is that it's happening amid rising tech investment, robust job growth, and a resilient consumer base. The most recent economic data still points to low unemployment, moderate inflation, and steady corporate earnings. And despite Monday's drop, remember this. Last week, the S&P 500 posted its fifth straight day of gains, powered by cooling CPI numbers and a temporary truce on U.S.-China tariffs. That tells us markets were already anticipating this kind of news and pricing it in. Let's not ignore the technicals either. The SPDR S&P 500 ETF, ticker SPY, ended last week above 594, just shy of its all-time high. And the NASDAQ QQQ ETF held above 521, even with megacaps like Tesla, NVDA, and AMD dipping in pre-market. As for investor positioning, hedge funds and institutional allocators are still heavily overweight equities, particularly in sectors tied to AI, energy, and infrastructure. All areas expected to remain strong regardless of sovereign rating shifts. So what's the bottom line? Yes, Moody's downgrade sounds ominous. But with a stable outlook, resilient earnings, and a broader historical context, this may be more headline than earthquake. Investors would be wise to stay informed, not alarmed. This is Robin. Thanks for watching. Subscribe for more level-headed stock news, and we'll see you in the next update.